Most Americans think the Federal Reserve is part of the federal government. It's not. Most people think it sets mortgage rates. It doesn't. And most people think it was created to protect the economy. That's debatable. Today, I want to explain why the Federal Reserve was created, what problem it was supposed to solve, and why the same system may now be one of the biggest drivers of inflation, asset bubbles, and housing unaffordability. This isn't a conspiracy video. This is history. And once you understand it, a lot of what's happening today finally makes sense. I'm Money Mike, keeping you informed. Before 1913, the United States did not have a central bank. Banks issued loans using hard money constraints, such as gold, silver, and actual reserves. If a bank loaned too much money, it failed. If it failed, it was simply gone. This created more discipline, less leverage, and more frequent but smaller recessions. But it also created instability. In the late 1800s and early 1900s, America experienced repeated banking panics in 1873, in 1893, and 1907. The Panic of 1907 was the breaking point. Banks froze, credit stopped, businesses collapsed. There was no lender of last resort. So the question became, who saves the banks when banks fail? In 1910, a secret meeting occurred on Jekyll Island, Georgia. Present were the following: major bankers, financial elites, and political insiders. Their goal? Design a system that would prevent bank runs, stabilize credit markets, and centralize monetary control. In 1913, the Federal Reserve Act was passed. The Fed was sold to the public as a stabilizer, a safeguard, a neutral referee, but its real purpose was simple: provide liquidity to banks when they overextended themselves. In other words, banks could now take more risk because someone would bail them out. Let's clear something up. The Federal Reserve is not federal, it's not a reserve, and it's not accountable to the voters. It's a central banking system made up of 12 regional Federal Reserve banks, privately owned member banks, a governing board appointed and not elected. Its main powers: control the money supply, influence interest rates, act as a lender of last resort. The Fed does not print money like a printer. It creates money through debt, bond purchases, credit expansion. Every dollar created is someone else's liability. The real turning point came in 1971. The U.S. abandoned the gold standard. From that moment forward, money was no longer backed by anything tangible. It was backed by confidence and debt. This allowed unlimited money creation, permanent deficits, artificial asset inflation. What happens when you inject cheap money into the system? It doesn't raise wages evenly. It inflates assets first: stocks, bonds, and real estate. This is why home prices exploded, wages lagged, and affordability collapsed. This is not accidental, it's structural. Here's where this hits home. The Fed doesn't set mortgage rates, but it absolutely controls the environment that determines them. Low rates plus easy money equals speculation, investor buying, over-leveraged builders, and overpriced homes. Housing stopped being shelter. It became a hedge, an investment vehicle, a Wall Street product. And once housing became an asset class, price stability is no longer the goal. Now the Fed is trapped. If they raise rates, asset values fall. Debt breaks, the system shakes. If they lower rates, inflation accelerates, housing becomes even less affordable. There is no clean exit. The biggest issue with the Federal Reserve isn't corruption, it's moral hazard. When risk is socialized and gains are privatized, discipline disappears, speculation increases. Regular people pay the price. Housing didn't become unaffordable overnight. It became unaffordable over decades of cheap money, bailouts, and asset protection. The Fed didn't break housing intentionally, but the system it created rewards inflation and punishes savers. This isn't about abolishing the Fed tomorrow. It's about understanding the system we live in. If we want affordable housing, we need price stability, not asset bubbles. Smaller homes, not leveraged speculation. Income growth, not debt growth. You can't fix affordability with rate cuts alone. You fix it by addressing the system that made prices explode in the first place. This is Money Mike, keeping you informed. Be sure to comment below and tell me your thoughts on the Federal Reserve.